this has been an experience of amazement to me.
Before you leave, if you'd like to watch another one of the podcasts, click the first link in the description. We love having you here and we appreciate all your support.
And with that, producer Barbie and I are out. Welcome everybody to another edition of Insights and Straight Talk. I am Rodd Duff, and I'm going to be right up front with you. I have a personal reason for being especially curious about this conversation. Because when somebody tells me that everyday people may be able to start building wealth through real estate without having a pile of cash in the bank, without having wealthy investment partners, and without spending thousands of dollars on some guru's coaching program. I want to know exactly. I want to know how that works. And I don't mean theoretically. I want to understand the numbers. I want to understand the financing. I want to understand the risk. And I want to know what kind of property we should be looking for here. What somebody needs financially to get started. What happens when renovation doesn't go according to plan? And where's the biggest mistakes? Where are those made? And Bryan, I'm going to put you on notice right now. I'm interested in potentially using the system myself. I'm probably going to approach this conversation a little different than somebody who's simply curious about real estate investing, okay? I want you to help me understand almost as though I walked into your office and said, Bryan, here's where I am. Can this work for me? And you know what? I think it's going to make this especially valuable for everybody watching, because there are probably a whole lot of people listening right now who have wondered that exact same thing. My guest is Bryan Anderson. Bryan, the real estate guy. Bryan is a real estate investor, licensed realtor, mortgage loan originator, a hard money lender, and author of It's Flippin' Easy. Love that title. He's personally purchased, renovated, sold, and held investment properties. But what really caught my attention was something Bryan calls live in flip. Think about that for a second. Instead of starting with the assumption that you need to become some big time investor with multiple retail properties, huge cash reserves, or outside investors, Bryan asks a much simpler question. You're already spending money every month to put a roof over your head, right? Is there a way to make that money now start working for you instead? That's where I became very curious, because we were just talking about this. Bryan has set himself a pretty remarkable goal. He wants to help 500 families build wealth using the money they're currently spending on rent. Now, I know there are people listening who immediately hear that and think, okay, what's the catch? Good. I want to know that too. What does without big money actually mean? How much money do you really need? What kind of credit score? What kind of credit do you need? What kind of mortgage are we talking about here? Where do you find? How do you find the right property? What does that look like? How much renovation can you realistically take on? what's a live-in flip versus house hack? What's the difference? What does DSCR loan? When does that enter the picture? When would that enter? When does hard money make sense? And when should somebody stay the hell away from it? What happens if the market turns? So many things about this. How and maybe here's one of the most important. Who should not do this? Because this show isn't about selling anybody a dream. It's about understanding an opportunity well enough to decide whether it makes sense in the real world. And that's particularly important when you're talking about, the great middle class. For most working families, their home is the largest purchase they'll ever make. Housing is one of their largest monthly expenses. And building meaningful long-term wealth can feel increasingly difficult, right? Think about that a lot. So if there's a legitimate way to rethink that housing expense and potentially turn it into an asset, building strategy, I want to understand that. And by the end of this conversation, Bryan, I want to be able to answer one very personal question. Could I actually do this? So, Mr. Bryan Anderson, as I told you before, we're going to start the beginning of the show a little differently. Oh, no. Hold on. Dang it. All right. Basically, what I wanted, I have a different way of putting this, but basically what I want to ask you to start off before we go back to your journey is, if I was to, what is the first thing? If I came into you and said, let's assume I know nothing about your program, and I sat down and I said, this is where I'm at. What's the first thing you're going to tell me to do?
The first thing I'm going to tell you to do is to look at your housing expense. What are you spending right now for principal, interest, tax, whatever? If you're renting, how much is your rent money? Because I want to help you get into a property using only what you're actually currently paying in rent. I don't want you to spend a dime more.
Wow. Okay. This is going to be a great conversation. I just wanted to set that up. As I said before, we'll get back into that. And as the questions come in, we'll probably get deeper. And one thing I don't think I mentioned in the green, you didn't text the green M&Ms, right?
What's that? I'm sorry?
You didn't text the green M&Ms, right?
No green M&Ms. Those are all producer Barbie. I know that rule.
Oh, yeah, you're the man. It's going to be a great show. We already have 300 people on.
That's amazing.
That's fast. Okay, so, and by the way, folks, I haven't even talked to much about this, but and we'll get into your journey in a second. What's that inflection point? What brought you onto the path that brought you your journey here with us today? But before that, you brought up something that was interesting that I found fascinating. I did not know. We're talking. Producer Barbie is out in California and lives there now, and I'm from there, and so forth and so on. San Diego is not exactly a cheap place for rent, which is an advantage, or is it a cheap place to buy a house?
Right.
Much less any of California, period. Right. But talk to me about that. You said something that fascinated me. You said the margins are better.
So it's actually the same amount of work in a different market, but the margins are so much larger that you see a bigger return on investment. I'll give you two quick examples. One of my examples, it's on my website, 23586 Via Navarra in Mission Viejo. Picked it up for $942, put 35 grand into it, sold it for 1.36. That's a $388,000 gross margin. Then I went to Colorado Springs. My oldest lives there in Colorado Springs. Picked up a property for $480,000, put 30 to 35,000 into it, sold it for $610, made $100,000. The amount of work was exactly the same. The amount of time, effort, energy, exactly the same. The difference, $388,000 versus $100,000. So yeah, in a high priced market, your holding cost, your monthly expense, your rent is higher. So someone can't walk out of Ohio tomorrow and expect to pay what they're paying in rent in Ohio to move into California. But any renter that's here in California is paying somewhere between $3,000 to $10,000 a month to live here. It's easy to turn that into wealth.
Yeah. All right. So we're gonna walk down that road, and we're gonna walk down all parts of it. Like I was gonna say, I don't think I mentioned this to you, but I'll probably interrupt you quite often to a degree, because you know terms that are everyday to you, and I consider myself a safety net. The audience, as I told you before, is very, very intelligent, and they're here obviously for a reason, and because they're interested in this. But I consider myself a safety net. If I understand what you're talking about, then they definitely. Just moving on, let's get into the journey that I like to open this show up with. How did you kind of start looking at real estate, at investing? And obviously you started in the real estate business, but where was that inflection point where you're now approaching it through this lens, and what you're wanting to accomplish? And I've never heard anybody turn it around and saying, hey, whatever market you're in, if you're paying the rental, and I want to get where that bridge is, but how did this start for you, and how did you go down this path? Why did you go down this path?
That's a great question. So I literally fell into this thing because I had no other option. So I'd love to tell you that I was well capitalized and I had investors behind me and all that fun stuff. I didn't have any experience. So I come from 30 years, 3 decades in working in fintech and insurtech companies in C-suite roles. So what I'm saying basically is I was in a higher.
Just for relevance, what are those two tech words that you just used?
Finance technology and insurance technology. So companies that were startups, for example, Landmark Home Warranty, I was employee number 9. We turned it into a $20 million a year business, and it sold to American Home Shield. Reliant Funding, we went from 60 million a year to 90 million a year gross and sold to LCF Financial. So my history, and I could go down a bunch more, but my history was I would work with startups. I was in finance, whether it's business capital lending, mortgage loan origination. I was a broker during the implosion of 07, 08. So there's a background there. And when COVID hit, Rodd, it was an aha moment for me. It was an epiphany. So COVID hit. I'm working in a C-suite role for a company in La Jolla. I'm driving every day from Oceanside, so it's an hour-and-a-half commute in each direction, right? Yep. The company shut down because we were doing business funding for small businesses, and a lot of flippers and all that fun stuff. Well, everybody was unessential in that moment. So literally shut down. And I sat there, just looking at my wife going, well, okay, what are we going to do? And the aha moment, Rodd, was that I had spent 3 decades helping other people make money. And I hadn't done it for myself. And so, like I said, I wasn't well capitalized. My back was up against the wall. I got a remote job. And because I was working from home, and I saved 3 hours in commute, I decided to take those hours and that flexibility to move around and turn it into wealth.
Wow. And so what did that beginning look like? So the decision was, and you know what's some of the greatest thing, well, a lot of the greatest things in the world, in life, come from I had nowhere else to turn.
Exactly.
When you said that statement, it's like that's when the human species, the human brain, or you can either fight or flight kind of sort of thing. The best examples of success typically, now it's fight. Now I've got to do something. My mind's got to be creative. Instead of panicking, you look within. What was that first couple of things? What was that? Give me a picture of what those first, I don't know, say this right, days or years look like.
Yeah, so it was funny. I'm sitting there in a condo on the beach. It was one of those vacation rentals, fully furnished, long term, spending I think it was like $4,500 a month, somewhere in that ballpark range. And my wife and I both got remote jobs, and we decided that we wanted to, get closer to where she was going to be working. She had to check into the office once a week, but it was in Orange County. So we decided to start looking for properties. And this is at the time where people were paying cash and they were outbidding each other and spending like $100,000 over asking. And everybody, yeah, it was crazy time. The interest rates were 2.9%.
And you know what else on that? People were like hiring people to camp in line for like new opening ones.
Yeah.
So there was all sorts of crazy stuff going on. Real estate was crazy. Go ahead.
It was nuts. So we're sitting there going, okay, well, we're in a spot, right? You know, we need to be a little bit closer and we needed space. So I want to paint a picture. The condo is an oceanside beachfront. There's no air conditioning. My wife and I are both going to work from home. There's no air conditioning. We're used to leaving the house during the day.
Right.
So it's 80 degrees in the condo. We could not possibly work from home in that situation. So we had no choice, but we started looking at homes that were at least 3 bedrooms. We're empty nesters, so we didn't have kids, dog, whatever. It was just the 2 of us. We started looking at homes and we got outbid by about, I don't know, after about 10 homes, we were about to give up. And then I met one real estate agent who, through my experiences, I did some hard money loans for him. He said, you know, I can help you out. Let me go and call up some FSBOs. And what I mean by that is for sale by owner, FSBO. Let me call up some FSBOs who've been on the market for a little while. And he found a person who was up against the wall as well. He already had a job transfer. He was moving to Florida. His new home purchase, he had a whole bunch of money down on it, and he didn't have time to do the remodels or the repairs on his existing home. He thought he could for sale by owner. And so he was backed up against the wall. The house was probably worth $1 million, and the value it would be after it was remodeled would probably be closer to 1.15, right? And so it needed just minor stuff. It really did. Like, he just didn't have time. So my agent represented both buyer and seller. We bought this house. It needed a range hood. It needed.
Wait, you and your agent together bought the house? Is that what you said?
No, just
okay,
me.
So you bought the house. Gotcha.
Right.
The one that your agent suggested.
My agent found the house and did what they, in California, dual agents are allowed. So he represented the buyer and the seller, and we got into the home. We purchased the home. Now, at the time, my wife and I had saved up our entire lives, you know, after raising families and everything else. We spent our entire lives saving up about $150,000 in our retirement plan. In hindsight, I would have, should have, could have used a down payment assistance program, but I didn't think I qualified. Now I know better. But at that time, I pulled that money out and I put that as a down payment on the house.
What's the program you just mentioned?
So there's in California.
Program.
Yeah, so in California, every state has these, but I'll just say in California alone, there are over 300 down payment assistance programs that you can qualify for, even if you earn up to 120% of the area median income. So for a family of 4, you could make about $150,000 a year and still qualify for up to 22% down payment and another 4% up to $10,000 in closing costs. So I could have bought the house with nothing out of my own pocket. I just didn't know that existed. And that was after 3 decades being in finance. I didn't know that. I didn't think I qualified because I'd owned homes before, but I hadn't had my name on title. I hadn't had my name on title for at least 3 years. Well, in the United States, if you're not on title for at least 3 years, you re-qualify as a first-time home buyer.
That's right.
They even have programs where you don't even have to be a first-time home buyer. GFSA, which is a group out here, it's government funded, will pay up to 10% of your down payment and you don't have to be a first-time homeowner. Again, it just goes off of the qualification, the very immediate income. So all of these things that I was learning after the fact, but let's go back to the house. I bought the house. We put about $35,000 into it. I did my own painting and landscaping. We hired contractors during lunch breaks. You know, they'd come to the house and give us bids and they'd work on it on the weekend. But it didn't really need that much. And when it came time to sell it, homes were spiking in value. The rates were still low. We decided for capital gains tax purposes to lower how much we were going to pay in taxes to hold the property for 12 months. And then we listed on the 12 months for 1.3. We had somebody come in and buy it for 1.36. But the monthly payment was less than what I was paying for rent in that beachfront condo. So I only had to use that. if I would have known about these down payment assistance programs back then, I wouldn't have had to pay any money out of pocket. The payment would have still been the same. But that was my first deal. Now I'm armed with 388,000 gross. I netted around 275,000. So that is my first start. Now, once you actually have $275,000, it makes it a little bit easier to buy the next one and the next one and the next one and the next one. But that first one, had I known, again, I would advise everyone to look into the down payment assistance programs in your area, because your bank won't tell you about them.
There still are these. They may adjust or different programs and so forth, but these things exist today.
Yes.
Right.
So if you just go to like Google or Chat GPT and say, list all of the active down payment assistance programs in my area, you will be blown away at how much government money is going into these programs to help first-time home buyers, or even, second or third-time home buyers, buy properties with no money out of pocket. They'll pay your down payment and your closing costs. All you have to do is qualify. Each one has some certain rules.
Give some idea about that. What's qualifying mean? I mean, go ahead.
Yeah, I mean, okay, so income qualifications, for example, the San Diego County Down Payment Assistance Program pays up
it's
to...
all of what we're talking about. Sorry for interrupting you, but I want to just dig a little deeper. All of what we're talking about now is income-related qualifications, whatever that is. Okay, go ahead.
So depending upon the size of the family, the income qualifications can go up or down. So there's more down payment assistance for someone who has lower income. So if you're at 80% or less, they're going to pay 22%. If you're at 120%, they're going to pay 17%. So if you're making $80,000 a year for a family of four, they're going to pay 22% of your down payment and 10 grand towards closing. If you go to, for example, and most people aren't told about this. Why not? I'll tell you why. And when I was a mortgage broker, it's more work, and I didn't take the class myself to be able to explain it to my clients. And the banks are paying a salaried person. They want you to fit in a specific box with your down payment because they're going to turn around and sell it to Fannie Mae and Freddie Mac. So there are reasons why they don't show them, but these programs exist
because so what you're alluding to here is they don't go down that lane for a couple of reasons. One, it just makes their job a little more difficult or challenging or busy or whatever.
They don't know about them.
Sounds like you have a water spray going on in the background.
Oh, yeah. Sorry about that. Hold on a second. You guys.
No worries.
Sorry about that.
So, no worries.
I've actually got a plumber here right now working on pressure regulators. So yeah, it's all the time.
Okay, well, good. Then do what you're doing.
Okay, thanks, guys. They just left. They're good.
All right. So now I forgot where I was at there. It's all, I know we were talking about. It's all about the income relationship, and obviously you've got to qualify for the loan. But they're starting all this because it's more inconvenient for them, so whatever the right word is. But also, it's harder to sell those, and we all know what we're talking about. They book all this stuff together and then sell it to another Freddie Mae or whatever, those folks.
Well, and I would say a third one is that.
Go ahead.
The third one is because most brokers, loan originators, and bank lenders, they're lazy. It takes work to actually research this in order to explain it to your clients. They don't want to do it.
Interesting. Yeah, that is that. Hey, one thing I didn't talk to you about when we were in the green room was this is a mutual work effort. We work together along the way. I put questions or comments up. The questions I like to read because I may change them and add to them or something.
Sure.
But I like the guests to read the comments sections. So I'm going to put a comment up, and I want you to read this from Clive right here. Could you read that out loud?
Great show, great conversation.
Yeah, I told you our audience members are really smart. What's
the? You got this one. Okay.
I get to read the questions. Easy now. Don't
all right. I get it.
Don't grab the whole show here. All right. So David asked, "What's the best?" And we kind of went into that. in my opening, right in that very opening of the show. What's the best first step for someone with very little money to enter real estate? And this is, I said in the monologue, there's probably a lot of people asking these questions, as I do. I mean, you live in this world, and so you get to see a lot of things, and then you start doing a little bit of research, and then you go, hey, there's something here, I could do this, and all of a sudden you're starting to learn a lot more about things, kind of like this show. I just started learning about this, and you get interested and you start digging in. But we talked about this a little bit. What is the first step? Like, where do I go? I know you said look at your finances, and you just gave an example of what the rent monies are. How do you kind of go from 0 to 5?
It's amazing. There's so many people that are already at 5, they just don't know it. So the first thing that I would advise is get in contact with a mortgage broker, not a bank lender. Go directly to a broker that has access to, like my brokerage, Equity Smart Real Estate Services and Equity Smart Home Loans. We have over 150 lenders in our network. Some are wholesale, some are correspondent, some are agency loans, meaning Fannie Mae, Freddie Mac.
What's correspondent?
So some of them we've negotiated an arrangement with for them to pay us money on the back end without having to charge it to the client. So in other words, they call it yield spread. And so if I give David Darnell a loan at par rate, let's say I give him a loan at 6.2%, they're going to pay me 1 point that David doesn't even need to know about because I found the loan and sourced it. So when you have 150 lenders competing for my business, they all want my business. I get hundreds of emails every day from all of them. And from those lenders, some of them are sell directly to Fannie Mae and Freddie Mac. These are your traditional conventional loans. Some of them are non-qualified mortgages. They're non-QM, another jargon that a lot of your listeners probably won't understand, but it just means they can't sell it to the government. They can't sell it to FHA, Fannie Mae, or Freddie Mac. So these are private money.
Because of it's a higher risk kind of thing?
Not necessarily a higher risk. It just doesn't fit in their specific model. So a traditional loan, so a traditional loan wants a W-2, 2 pay stubs, and 2 years on the job. They pull your FICO score, your credit score, and they look at your debt to income ratio. These are all things that you all know about. A non-QM says, all right, some people out there, they don't look so good on paper. So if you're a business owner, you're an Uber driver, you are somebody who works in construction, you're somebody who gets tips. Well, that money doesn't reflect on a W-2. And so we can look at, I have lenders that will give you a loan based on your personal or business bank statements, your average deposits. I got lenders who will look at a 1099. I got a lender that will do asset utilization, meaning that, this retired couple came to me. They're like in their late 60s. They just started getting Social Security, and they only on paper make $4,200 a month. Now they got $2 million in savings, but they only on paper make $4,200. And in California, you can't buy anything at 40% of that income, right? You just can't, so you don't qualify. So what an asset utilization loan does for non-QM is they will take all of your money and they will divide it by 60 and say, that's how we're going to qualify your income for a mortgage. So if you have $500,000, let's say $550,000, I think you're going to come out with about $9,150 as far as gross income, because they're just going to take your assets and turn that into income to qualify. Now, the government doesn't meet the government's guidelines, but it's just another way to prove that income is coming in. A lot of retired folks are selling some of their mutual funds every month to pay their bills. So there's a non-QM opens up more freedom for people who aren't going to typically fit with the bank. So most of my clients that I do loans for got turned down at the bank. They got turned down from other lenders. So my first advice for David and all the other folks that are asking the question is, go to a mortgage broker that has access to hundreds of lenders in different loan programs. They can do fix and flip loans. They can do hard money. They can do DSCR, and we'll get into all those. They can do traditional loans. They can do non-QM. They can use your bank statements. They can use find a lender that can help you, and that person becomes your partner for life. Because no matter what you do moving forward, they already have your finances. They already know your situation. Yes. They can help you get there. Whereas a bank teller gets a salary, and they could care less if you get the loan or not. You either fit in a box or you don't, and that's all they care about.
Yeah, and that first part of that ending of what you just said is obviously important, because you find somebody that works, then that relationship begins to build. And it's like in anything else, especially transactional, anything else, that relationship makes the transactions over time better, all the way around, because you're knowing each other. I use AI a little bit in this example these days, because it's true. Like, agents get to know you. So as you're working with an agent, in this case, a person, right, a human, and the other example of an algorithm or whatever you want, whatever agents are. But that AI gets to know you. Just like when you have a business partner, the more you know each other and get that along, the better those deals end up working. And probably on top of it, you get the opportunity of somebody says, "Oh, you know what? He'd like this," and would actually, you probably find more stuff because of that relationship as well.
Well, it's not just the relationship. My whole point that I was trying to make is that like 90% of the people who've come to me and been turned down by a bank, I can get them a loan. Like, it's crazy.
Wow.
They just don't know.
90%
yes.
of the people, 90, that's a big number. And it's because of these other things that other people aren't.
I don't have enough down payment. My FICO score is only a 580. My bank said no because of this reason or that reason. My debt to income ratio is not, whatever the reason is, they come to me and I'm like, well, that's because your bank can only sell one of three type of loans. They can sell a primary residence traditional loan. They can sell a conventional loan, or they can sell a home equity line of credit. They're done. I have hundreds and hundreds of lenders all across the board. But anyway, it is shocking to me how many people just don't believe it. I mean, my sister, for example, she was adamant that she could not get qualified. She went to a bank, she went to another lender. They all said no. And they said, well, you don't have enough down payment. I sent her to go get a down payment assistant. She spent 90 minutes on an online thing. It turned around and gave her $19,000 down payment assistance paid for by the government to help her get into her house.
Those sisters, man, they're going to pay attention to us brothers a little bit more often every now and then.
Yeah.
Well, she did, though. It sounds like, but that's fascinating. 90% of the people that aren't, and this is across the country. It's not just California, obviously. We're talking to people in Ohio here, and as well as in Arkansas or Oklahoma or wherever. That's a fascinating statistic. This is a good question by Rodd here, Rodd Jr. How much savings should a beginner ideally have before trying to live in flip? And this is where I want to get into this, because that concept to me is very, very fascinating. What do you mean by a live in flip? In other words, just like you would be moving into a home while you're rebuilding it, then you flip it. Tell me what that looks like. Live and flip.
Sure. So this is going to sound like a controversial and even hard to believe answer, but how much savings should a beginner ideally have? I'm going to say, how much does it take to rent a U-Haul to move into that home? That's how much you need. It's really crazy. So the way that this works is with a combination of stacking. And I'll use this term to try to explain that. First layer is you get the mortgage loan, right? Now, mortgage loan is, all right, so if you're getting a loan that I would advise for somebody who needs to fix up a property, you'd think the old school way, let's understand how they work. So the traditional flipper can only offer on a hard money loan like 70% of the after repair value. So how much a house is going to be worth after it's fixed up. The lender will only go 70% minus the cost of remodeling it. So that's why you're hearing about these lowball offers. If a home's going to be worth $1 million when it's done, then a hard money lender will only give you $700,000 total to buy it and fix it and send it. So they have to bring in a lot of money. Then the clock starts ticking on day one, right? They've got 2 months of fixing it up, and then it's on the market for 3 months. It's vacant. Well, in California, you're sitting on $1 million. That hard money cost is about $10,000 a month. So every month that goes by, you lose 10 grand of the profit on that deal. So that's why they have to go 70% max, is they expect the home is going to sit on the market for about 3 to 6 months. So part of that is that cost. Now, if you're doing what I'm suggesting, and this is something that's going to blow your mind, these loans exist and nobody talks about it. there's a Fannie Mae Home Style and a Freddie Mac Choice Renovation loan. The Fannie Mae.
Hey, hold on. Can
Sure.
I interrupt you for a second? Well, I just did interrupt you. So,
Yeah.
we have almost 1,000 people on the show right now. I haven't had somebody 1,000 people on the show in months, literally.
Well, this
months.
is a big deal, Pete. There are a lot of people sitting on the sidelines going, "What the
I
heck?"
just noticed that.
Yeah.
There's just under 1,000 people. Go ahead with where you are, but oh my God. Good
So
for you.
these
Go ahead.
these two loans are designed, and they're government subsidized or supported, if you will. But there's actually three based on your FICO score. If you have a 580 or better FICO score, you can get about a 96.5% loan with FHA 203K. Now, this is a single loan that
Is this
will
anywhere in the country?
anywhere in the U.S.
Okay, go ahead.
FHA 203K that will actually pay. There's a standard and then there's a smaller one, but nonetheless, they will pay one loan to buy the property and fund all the renovations. And if you've never done one before, they will appoint a HUD counselor to help you manage the renovations. And if you close on the 5th of the month, you're going to have 55 days worth of interest built into your loan. It's called per diem. That gives you enough time to have the home completely remodeled before you even move into the property. So you move into a property where the majority of the remodels are already done. You're walking into major equity. And then over the next 6 months, maybe you do some painting. The next loan is Fannie Mae Home Style. Now, Fannie Mae Home Style, if you have a 620 to about a 680, this is a great one. They'll pay 97% of the purchase, okay? And that one loan is going to pay for the purchase and the remodel expenses, okay? Then the Freddie Mac Choice Renovation, if you have over a 660 FICO, they're going to pay 97%. Now, on top of that, we're going to stack on a down payment assistance program that's eligible on any of those loans. It's a government subsidized program on a government subsidized. I mean, you're basically
literally stacking on top of these other 97% kind of things.
So now you get 100% loan to value,
Right.
100%, no money out of pocket whatsoever to move into a property that is fully turnkey renovated before you even move in on day one. And you spend the next, 6 months, because the loan is going to get called due commission to the lender if you pay it off within 6 months. So you need to hold the property for about 6 months. If you hold the property for about 2 years, then you've satisfied the down payment assistance program. There is no monthly payment on the down payment assistance until you sell or refinance. So I want to just make sure I start this over for as clear as I can. You go to a mortgage broker. You qualify for a FHA 203K, a Fannie Mae Home Style, or a Freddie Mac Choice Renovation. You stack on that a down payment assistance program that'll cover the down payment and closing costs. Then the seller, who is thrilled that you're there, will offer seller concessions to pay for any additional costs that you might need as far as even moving, right? So you're talking about stacking an agency rehab loan, a down payment assistance program, and seller concessions to make sure that you're not coming in with any money out of pocket.
What
You're going to
do
have
seller concessions look like in your world?
So let's say that a seller concession, the federal law, I think that you're only allowed like 3 to 6% of the home value for seller concessions. But let's put it this way. A hard money and traditional flippers show up to these poor people and say the house will be worth $1 million later. It needs $100,000 in rehab. So I can only give you $600,000 for your $1 million home. Okay, now that's what happens every day in this country. You show up. That's right. So they need that margin because they have to pay for agent fees, they have to pay for holding costs, they have to pay for builder's risk insurance, they have to pay for all these things that a traditional home buyer. Yeah, but if you're a primary residence, now you qualify for loans they can't get, and you can offer up to 97% of the after repair value all in one loan from FHA or Fannie Mae or Freddie Mac. So you don't want to do that, obviously, but you want to give more than what the traditional flipper can do, right? So if I know going into it that the traditional flipper is only going to offer this poor guy $600,000, and I go in and I offer him $650,000, but I want him to pay $30,000 towards closing costs, or whatever I want him to pay it for, whatever the maximum allowed amount is to pay all my closing costs and whatever moving expenses, he's still going to make $50,000 more than if he accepted the lowball offer from a flipper. Now I get the property, and remember, I'm picking up the property for $650. It needs $100,000, so I'm going to get a loan from Fannie Mae, Freddie Mac, or FHA for the total amount of the purchase and the rehab, which is $750,000, right?
Yep.
There's still a $250,000 margin. I move into that thing. So I help manage the contractors and get it done before I move out of my rental or wherever I'm living now, because I got about 50 days. If you close on the 5th or the 10th of the month, and you that's standard on a traditional loan, that they're going to wait, you can have it built into those 55 days. Well, that's part of the closing costs. I'm going to have my seller pay for the holding cost for those months that I'm having it remodeled, because he's going to give me some seller concessions. So basically, I'm stacking a primary residence rehab loan, a down payment assistance that is deferred interest, no payments until you either sell or refinance. And in some cases, if you stay in the home for over 2 years, then it's forgiven. So there's a deferred interest, there's a forgiven grant. So you can literally walk into $250,000 in equity on day one. And over the next 6 months, do some landscaping, watch what the neighbors are doing, maybe dress it up a little bit, but you've already done the major remodel. I do the painting myself, because painting is expensive. And I know that over the next 6 months, I can paint, right? I can dig up some trees, I can plant some bushes. So those are things that I know how to do. So literally, I have helped people get into a property with no money out of pocket, with as low as a 580 FICO score. And if you've got a lower FICO score, you're going to pay mortgage insurance premium, which is about 6 months of your mortgage insurance up front, plus you have a PMI or a MIP monthly. There's an insurance premium when you go over 80% loan to value. Well, that's fine. That's why you're asking the seller concessions. You're paying the seller $50,000 more. He's going to kick back $30,000. It's going to pay for all those costs up front. So I'm helping people get into a property with nothing out of their own pocket, using loans that are designed by our government. These are literally funded by federal and state programs for down payment assistance, with loan programs designed to help you get into your house. There's even a website called Fannie Mae First Look Home Path website that will only allow primary residence buyers for the first 30 days. They won't even entertain an offer from an investor for the first 30 days, because they want to encourage primary residence. Why is the government doing all this? Because they understand that home ownership leads to wealth, and that wealth leads to less dependence on food stamps, welfare, all these different things. Think about it. If you're sitting on $500,000 in equity and you lose your job, you're not going to get on welfare and food stamps. You can sell and you can move around. So the government is actually encouraging, these type of programs. Now, how many people have heard about a Freddie Mac choice renovation agency rehab loan with a down payment assistance deferred and seller concessions? Nobody. And so when I start talking the talk and I say, listen, it's one thing in theory. Now, there's a lot of coaches out there that want to sell you a $30,000 program to try to teach you how to invest like a flipper, and how to do it on a vacant, and how you need them. And you don't need any of them. You can buy a primary residence. And here's the best part. Let's say the market changes. You got to live somewhere anyway, right? You just stay living in your house, paying your monthly payment instead of rent. And when the market changes in your favor, then you can sell. If you want to pay less in taxes, hold the property for 12 months or 2 years. 2 years, the federal exclusion goes down to 0. 1 year, it goes down to 20% instead of regular earned income. So I hope I'm not talking too fast for your listeners, but the idea is there are programs where you can go buy a property and walk into hundreds of thousands in equity, at least in California. Now that margin is going to be smaller in other markets, but you have to start somewhere. Start from what you're currently paying in rent. Find a property where the principal, interest, tax, and insurance is equal to or less than what you're currently paying in rent. Look on Zillow or on your favorite website where you're looking on the MLS. Don't deal with wholesalers or off market. Like literally look on the MLS and find properties that have open houses that are distressed. Go into there and talk to the agent that's at the open house. They have their finger on the pulse of every distressed property about to hit the market, right? So you walk in and you start making friends with real estate agents. Then you let every single one of those agents know, if you can find me a property, I'll let you represent me, both when we buy it and then again when it's time to sell it. And they're looking at me with my pre-approval letter thinking, all right, I'm going to make 60 grand off this guy. Now they're going to work. That's how you play it.
Yeah, and that's where that relationship starts, because now you're saying, and when I'm going to sell it, and I know you're a flipper, and they are, that's a proper term, right? That's not a disrespectful term.
Well, when you're a primary residence buyer, you're not really a flipper, because that is a negative connotation. You're actually buying as a primary, but with the intention of selling it after you're done remodeling. And I mean, the agents love that. They're going to be able to list a turnkey property and get more commission.
Exactly. That was the point I was getting. Yeah, there you go.
Then they get to stand in your open houses turnkey and entertain who's coming into open houses. Have you ever seen people bring a real estate agent with them into an open house? Once in a while, most of them are unrepresented buyers that are thinking, I got to sell my place, got to buy a new place. So that agent is using you not only to make commission on finding the deal, they're going to make commission. Yeah.
Oh man, that's a beautiful evolutionary step, stepping process. Danny here, this was something I'm curious about as well. What makes a property a good candidate for a profitable live-in flip? Still trying to get around this live-in flip. And, before you go there though. So your program, you're looking at helping 500 families in this program. Answer this question, but before that, kind of give me an idea of, like I said in the beginning, I don't know anything about your program. Not only can I do this, but what does it look like? What's that?
First of all, I'm not selling a program. Everybody in the education, real estate education, the investor education business, it's a multi-billion-dollar business that are just raking people. I mean, if you look up FTC, scams, shutting down real estate investment scams, I think they've reimbursed 27 million just in the last 3 years, because people are getting fleeced at the average of $10,000 for a program. I'm not selling a program. I don't want your email address. It's not a lead into a sales funnel. I mean, if somebody needs help finding property in Southern California, I'm happy to help, but I'm doing this because of a commitment that I made. When I first started one of my early flips,
there you go. Yep.
I had a contractor.
Yeah. Right.
I was working on a property and he was just like, man, this is so cool. I love what you've done with this place and everything. And he was like, how did you get into flipping? And I told him my live-in flip strategy, and he just sat there aghast. And he just was like, bro, people aren't going to believe this is real. Like, you need to write a book and teach people how to do this. And at the time, I kind of laughed it off and I said, okay, you know what? I'll tell you what, as soon as I hit my number, and I told him my number, as soon as I hit that number and I don't have to punch a clock anymore, I'll write a book and I'll teach people. I'll teach 500 people how to do this. And I shook his hand, and that has been driving me ever since. So again, I'm not selling a program. I do have a downloadable ebook for $10, or you can buy the paperback for 20. But there's enough information in there that you could literally just read through that, and you would be armed with everything you need to do to meet the right people, where to meet them, how to find a property that's a perfect live-in flip, how you want to build your business without ever spending any money out of your own pocket. I wish that somebody would have given this to me when I first got started, because even after I paid off the money that we withdrew money, my wife and I withdrew money from our savings to put it as a down payment on a house. And when I realized later that I qualified, our 2 new work from home jobs, we definitely were at the 120% AMI. We could have totally gotten the entire down payment and everything paid for. But when I sold the house, I paid back the down payment, and I had about $275,000 net after paying agents and everything else. But even that moment was an aha moment, because I saw that my agent was making a ton of money. So I decided I'm going to start getting my own real estate agent license, so I don't even have to deal with an agent taking a piece of my action. And that's how I became a real estate agent. Not to help anybody else find a house, but just to increase the ROI on my own deals.
I like using the word ecosystem, because this show is kind of an ecosystem. We have this live, right? And then we do 3 Substacks a week, and I write the Mangum Star column and a couple other things. And that's an ecosystem, because it's all kind of supporting each other, right?
Yeah.
And what you just described there is literally support. And it, not only that, but it also gives you an additional look, or approach, a different way, you know, as an agent, your finance and the agent looking for the home, you know, that's a complete pie, not just slices of one, right?
My evolution as I went through it is I started writing my own hard money fix and flip loans for myself. You can't write your own traditional loan for yourself. You can't do that. You can't do it even on a DSCR loan. So you still have to have friends at the mortgage broker to do that.
Sure.
But when I bought the house, now that I'm a real estate agent, when I buy a house, I actually part of my request in the contract is I get paid commission to buy my own house because I represent it. That comes from the seller, right? They would have to pay it anyway. So I'm getting paid on day one. I'm getting somewhere between $10,000 to $20,000 for 1 point to 2 points on day one as the agent. And I get paid on a yield spread from the hard money lender. So I'm making another point over here. So before I even walk into the property, I'm putting 30 grand in my pocket. Then when it's time to sell it, I'm not going to pay an agent to buy the property. I'm going to represent both the buyer and the seller. So I have to host my own open houses and everything else. But the idea is if somebody walks into an open house and says, you know, I got to sell my house and before I can downsize and buy this one, now I'm going to represent you selling your, you know what I mean? Like there's a whole opportunity that just compounds over time. Yeah.
So what, I don't know if maybe we hit there and I'm just not grasping it yet, but that live and flip, what does the right property look like? Something that you can live in, and you can stretch those numbers, and just the 30-foot view, just to make sure I understand the whole picture there. What does that look like as you're doing it? What makes one property better than the other is where I can maybe connect to it.
So first, take all the emotion out of it and let's just look at the numbers. When you go into like Zillow, you type in certain keywords like distressed or equity or TLC or flippers. So real estate agents are actually trying to get attention of these flippers by putting attention real estate investors, attention flippers. This is a cosmetic, remodel. So you use keywords to find them. Then once you find them, you need to find 3 recent comparable homes. So 3 homes that are similar in size, bedroom count, bathroom count, and square footage that have recently sold after being remodeled. So you have a good number.
Yeah. So
now you have within a mile of your home, and this is what I did. I found 3 other properties that were stunning. They were after, my house that I was buying was kind of a before, but these are after, right? And so you see these homes that just look beautiful and turnkey that sold for $1.1 million or $1.2 million. And so you know what that number is going to be afterwards. Then you have to figure out what the remodel costs are going to be. You don't have to be a professional lender. You don't have to take classes to learn how to do the loans. You go find a partner that can help you do that. Then you call up different contractors. You have pictures on the MLS. So you pick up the phone, you call a contractor off of Google that has less than 50 reviews, but they're all 5-star. And you say, hey, I'm a flipper in the area and I'm looking to purchase a property. But before we do, I'm new to the area and I wanted to get a feel for what the cost would be to make house A look like house B. So I actually have pictures off the MLS of what one of the comparables look like. I want to make my house look just like that one. I don't need a designer or anything else. I'm asking a contractor on the phone, how much would it cost to make this house look like this house? And then he gives me a ballpark figure and says, I'd need to go see the property in person, but this would be, now they're looking to make some money, right?
Clever.
They're looking to make some money. So then what I do is say, great, can you meet me at the open house on Saturday? And you do a walkthrough with them. Or if you don't have, if you have an agent, you have the agent meet you there. If you're like me and you're your own agent, I show up at the lockbox, open it up, and me and my contractor walk the property. But they're going to give me a ballpark up front of how much it's going to cost to make house A look like house B. So if I know I can buy the house for this price, it's going to cost this amount of money to remodel it, and this is how much is going to be left. I only look at properties that leave me at least $100,000 after paying all of my upfront cost and the remodel cost and everything else. And I'm only going to pay monthly what I was paying in rent before I moved there. So my wife and I have had 6 different primary residence addresses in the last 5 years. And that's okay. That's not even all my properties, because I do buy other properties now. But when I first got started, I just bumped around. I just started, I bought one, I sold it. The next one took only 6 months, sold it. The next one took 7 months. So the idea is that you have to be flexible, and you can find properties all in the same city and still commute to work. But it's really helpful if you're in a spot where, you can kind of choose homes from all over the area. Like we got to experience Mission Viejo, Huntington Beach. I mean, we were just all over.
That's where I'm from.
Yeah,
that's where I'm from.
So
I graduated from Huntington Beach High School. That's an adorable.
It's
little,
awesome area. Yeah,
it's kind of a Newport Beach light.
Yes.
You know what I mean by that?
Yeah.
Kind of, and it's got a little bit different vibe.
It is like you're up there and you've got an e-bike and you're doing live concerts on the sand, and so I'm experiencing life as well while I'm doing it, and it's fun. Now we're having a good time. But when you first get started, the idea is to find a distressed property somewhere near your home that has enough margin. Now you know what the professional flippers are going to offer. You come in with a little bit more, you stack, you get to walk in with equity. When you sell the property, you walk away with all that cash. Now it's a matter of, well, what am I going to do with this cash? And now you have this insight where it's like, oh, this is cash. Now, it doesn't mean you have to sell right away. Like I'm in a condo right now that's beachfront and Oceanside, really close to the place I was renting when this all started. I picked it up for 1.25. I put 30 grand into it, just a refresh remodel. Had it reappraised at 1.415, which is 130,000 in forced equity. I used that forced equity as a home equity line of credit, and I used that to buy another home at the Havens Country Club in Vista. That property was an $860,000 purchase. I put 200 grand into it. It's now worth 1.25. I've got another 150,000 over there. That one didn't sell right away. I decided to keep it as a rental. So I have that one as an investment property that I had to refinance into a DSCR. So all these loans matter. In just these two properties, I had a primary residence, I had a home equity line of credit, I had a hard money fix and flip, and that I used the HELOC to fund. And then I have a DSCR, which only takes into consideration rental income. So they didn't have to pull my personal credit. They could care how much money's coming in versus how much is going out. If that number's greater, you can get a loan without anything else. So there's a lot of different ways to skin the cat, but the idea is
you literally in a real rental property, investment property. By the way, I'm glad I re-asked that question about the live-in flip, because that's
I'm sorry if I got off track. That's my fault.
No, not at all. I'm saying the opposite. I like re-asking questions sometimes, because we can kind of, I like looking at a house through different windows sometimes. Yeah. And that second, the first one was awesome, but now I'm like, oh my, it just blew my mind.
You get to use your forced equity in your live-in flip because it's a primary residence loan. You don't get to put a HELOC behind a hard money loan. So you get to use the equity in where you're living to fund your next deal before you ever move out of it. There's so many different ways to play the game. But again, some people will look at this book and they will say, I just want to buy a primary residence. And they want to walk in.
On Amazon, by the way?
Yeah.
Awesome.
Yeah. So it's on Amazon, Kindle, everything. But some people will want to just learn how to buy a primary residence using only what they're paying in rent with no money down, and they have lots of equity and they're done. They're happy. That's all they wanted in the first place. Yeah. Other people will say, holy cow, that was easy. I'm going to do this again. And if you put your mind to it, within a few years, you're done working. You quit your job and this is your full-time endeavor. And you created enough wealth. Like my wife and I, we don't work anymore. We're literally living on our savings from the money that we made from these different live-in flips. Now, there are a lot of guys out there, Rod, that try to sell you on the idea of you can buy this property in Ohio for $70,000, put a Section 8 renter in it, and have cash flow of $500 a month. And I'm thinking, how many months have to go by to get your $700,000 back? Yeah. Well, even if you only put 10% down, I put $70,000 down. How many years has to go by before you even get your money back? I want to put nothing down, walk out with $100,000 in 6 months, and go do it again. And I'm teaching people, if you're looking to be an investor, it's a great way to start without coaches, without cash, without partners, without all of this garbage. And there are plenty of people that are out there wanting to help you win. as soon as you get over your personal fear. My fear ended when my back was up against the wall, but other people are looking at this going, you know what? I am tired of paying rent. What do I got to do? So.
Wow, sorry, I was just looking over at the private chat, looking at what contact information. I'd like to put that contact information out there. You ended. I didn't keep my promise. You ended sooner than I did, so I didn't get back soon enough. I didn't. I looked real quick. It looked like it's your website. We're not done talking, by the way. I'm just really fascinated by this. And like I told you in the beginning, I have my own personal reasons. I moved into a small town, a bit different situation in San Diego. I moved from Chicago. So Barbie and I were in Chicago. Producer Barbie and I, we spent 20 years together. She's still a big part of the show. But she was having grandchildren. They were in California. I was having grandchildren. They were in Texas. So due to life circumstances, it was a good situation. Right, yeah. Good friends, right? And but I live in Mangum now. She lives in near Temecula. I forgot the name of the town, but you know,
Murrieta?
Not Murrieta. That's a little. I love Murrieta.
Fallbrook?
It starts with a W. Winston.
Okay. I'm not familiar.
It's a little bit. It's a newer part of that area. It's kind of like Ladera Ranch for Mission Viejo.
Yeah.
You know what I mean?
Yeah, I get it. I mean, there's a lot of booming towns.
I think it's called Winchester.
Yeah. Okay, I know what you're talking about now.
It's near Temecula, I think.
Yeah.
I've never been there, but anyway. So I live in Mangum, and I've got the ability. I bought a property here, and I paid cash for it. And now I'm looking at a couple of other properties. It's a smaller house, much smaller than I've ever lived in. But because of the situation of what I wanted to do, I'm buying the property next to me that has a couple other houses, and all that property is a big amount of property. Yeah. And so I want to combine the houses. Is there any way to kind of flip that kind of situation where the numbers are much smaller in that part? But as far as the loans, maybe I'm asking a silly question, but I would like to see how I could maneuver money in being able to acquire the property next to me that I eventually want to. I want to be able to put 3 houses in a row. That's one house. Does that make sense?
Sure.
I'm not a real estate guy, so I'm using very technical terms.
Well, it's really interesting. You can actually leverage the land or the value or the home on one property to get enough cash out. And the idea is to get, so there's a HE loan and there's a HELOC. There's a couple of different ways you can do it. There's new construction loans. There's all kinds of ways to leverage the land or the property to get the cash out you want. And again, this is not something that your bank does, but you go to a mortgage broker, they have access to all of these different type of programs. But yes, the answer is yes. If there is equity, if there's cash available, then yes, you can do it. And a lot of people don't know this. Some of your listeners right now, I got to tell you, they probably are living in, I would say about half of California, 45% is tenant occupied of all of the homes in California. 55% are
tenant occupied is a rental phrase.
Right. So that means that 45%, all of the residential properties in the entire state of California are occupied by a renter, not an owner.
45% of them, almost half.
Almost half. And so now there are certain areas like right here in Townsite, down here in Townsite, Oceanside, beachfront property, that number moves to 67% tenant occupied. It's huge. It's just Airbnb and short-term and long-term, mid-term. And so these people are just sitting on these. Yeah, I mean, you've got an unobstructed view of the ocean. It's just going to keep going up. The appreciation here is staggering. So if you can afford to hold a property here, it's crazy. But, everybody's got different ways to access equity. So those of your listeners who are homeowners, okay, they're like, I own a home. I don't want to move. I don't want to jump around and live in your flip. What's in it for me? What can I do? And that's where I teach people. It's like, let's tap the equity in your existing property, get a home equity line of credit, and use that for a fix and flip hard money loan. Now you've got some different rules there. It's vacant. It's going to cost you. You need to have more money in reserves. You're going to have some different things. But the idea is that money's not doing a darn thing for you right now. It's just sitting in equity. Why not use that if you can create wealth? So, and you're not limited to just buying in your own market. You can buy wherever you want. It really just comes down to what your risk tolerance is. But you think about it, it's one of the greatest hedges against some volatility in the stock market. Because if the stock market drops 30%, your home didn't drop 30%. If the dollar's weaker, it's going to take more of them to buy my house. Either way, it's a leverage against those risks. So, I always encourage folks who are looking to retire faster and they don't want to move around, tap the equity that's in your property to go and purchase some, DSCR properties, some properties that you can rent out for more than what your payment is. And especially in a market where appreciation is somewhere between 4 to 14%, like here in Southern California. It doesn't work too well right now in Florida, but again, you're not limited to where you live. You can buy a property anywhere.
What do you mean it doesn't work too well in Florida because it's more of a depressed?
Yeah, so if you look at the map,
situation?
Well, if you look at the map, so there's several different maps that talk about appreciation and depreciation, and what home values, what that number looks like. So every market is different, right? Every single market's different.
Yeah.
Right now in Southern Florida, the value of properties is not going up. In fact, some of the property values are going down, and that we're seeing that happen in a lot of different markets. Well, in other words, if you live in a market where it's not appreciating in value and you want to buy some rental properties, it would only make sense to buy those properties in areas where there is consistent year-over-year appreciation. And that's, again, it works in some markets, it doesn't in other. My wife comes from Ohio, and a lot of her family members, what they paid for their house 10 years ago, they maybe have $20,000 in value more than what they paid 20. So it just depends on your market. But if you're going to be a landlord, for crying out loud, buy something in an area that appreciates. That way you get cash flow and you see a return on investment. So let's say in that city that you just mentioned, let's say Winchester, their appreciation is about 4% annually, or at least it is in Murrieta. Okay, so that's close enough. So in Murrieta, right. So let's take that number. Let's say 4% appreciation. Some guy that's sitting on 40 grand in cash says, well, I'd rather invest that in the stock market instead of putting it as a down payment on a house. But they're paying $3,300 a month for rent. So you take two people from the same place. One of them puts $40,000 down in a home that's worth 400 grand that appreciates at 4% annually. The other one puts 40,000 in a stock market that appreciates at 10% compounding interest annually, right? Who's going to have more money in 10 years? Most people get this wrong. The home, so think about leverage. 4% on a $400,000 home at the end of year one is $16,000 appreciation. Yep. 10% on 40,000 is only 4,000 in appreciation. Yep. And so a lot of these guys have this idea that their money is going to make more money because they think, well, 10% better than 4%, right? No, it's about the leverage. Size of the asset is what matters. So that's what I'm teaching people is how to rethink what they were originally taught, because there's so many different ways to get out of working and punching the clock sooner than later.
We've been going well over an hour now.
Sorry, guys.
It's just no. I mean, it's just going by really fast, and it's like. And by the way,
I wanted to mention too, really quick, on my website, BryanTheRealEstateGuy.com, I actually use pictures of these properties that I just discussed, where I actually show before and afters. I use the examples so you can actually see what those properties, what I did to them. And I think that a lot of people, have been taught things in theory. And a lot of books are written about theories and ideas, but not real world experience. I want to show people these are my homes that I purchased. These are actual homes. This can be done.
Yeah, and that's what I love about this show, is because it's about empowering the great middle class, one conversation at a time, right? That's our tag. That's our pitch, right? Yeah. But more than that, or deeper in that, is there's a lot of information out there that, let's call it the elites, right? They have a lot more money, a lot more access. Nothing wrong with that. There's nothing wrong with that. But they just have access to that, and it just becomes easy to move things along. And people in my audience, our community here, we're in a world of, that's not readily free, easily sought out. Now, ChatGPT is changing things, and it's easier to search. I'll give you that. But this conversation here is not something that this conversation here is something that nobody, they have access to it, but they don't know where, right?
Exactly.
I mean, we're bringing that here. And that's why I love this show so much, because this is huge. I mean,
it is huge.
One thing you said a little bit ago, you said that the government actually wants you to have established wealth. They want, because it lowers the risk.
It's good for the economy. It's good for the economy.
It's great for the economy. And actually, the original Bill of Rights, it was, the freedom, happily to live happily. Now I'm going blank on what that term is. But the original version said land was included in that. It wasn't happiness. It was land, the freedom to be, and because that's always been important. And you said it. It's a difference in that feeling that you're paying into an investment, or that investment actually, in the way you're taking it another lever, is literally paying into itself, versus sitting on rental property, of which almost half of it is in California. But and just feeling like that money being thrown away. And I know that feeling. I've rented before, and I've bought, and there's a different kind of ease and calmness, because it doesn't feel like your money's coming in just to go out. Now it's coming in and it's huddling for a while. And maybe you've got, what you say, 9 grandkids. I have grandchildren too. It's eventually being passed through, and hopefully bringing the success of the family up overall. Roy Drink has a great comment here. Would you read this out loud, please?
Really valuable information for anyone thinking about buying their first property.
And he's just talking about the first property, so obviously he's got something in mind here. But you're talking about that continues, and then you're using that value on down the line. We've got a number of questions about finance, the financing side of things, which you brought up. John Morris here. Bryan, what's the financing option you would recommend for a complete? Because you've kind of broken down those. The broker has access. You have access to several different programs that work perfectly. Now, this person's talking about, when they say complete beginner, I'm assuming they're literally looking at this as a flip, kind of as a business, versus just being, like you said about a half hour ago, hey, I just want to have my home. I just want to buy my residence. I want it to be nice, and that's all. I'm good. I think this person's that next level in the flipper. What financing option? And I know it depends on there's a lot of unanswered here. We don't know a lot about John, right? What's his credit score? But can you talk to John about this?
If you're a W-2 employee with pay stubs and you can qualify for traditional, your FICO's 580, you need an FHA 203K. If it's a 620, you need a Fannie Mae home style. And if you have over a 660, you need a Freddie Mac Choice renovation. You're going to get one of those loans, and again, stack a down payment assistance program. Look online. Now, I tell you what, ChatGPT is amazing if you know what questions to ask. But those are the 3 right there, right? So those are the 3 main ones. Now, if you're an Uber driver and you don't qualify on paper, you're a business owner, and your tax returns show that you've lost money, even though you have plenty that's coming in, now you have to go the non-QM or the non-traditional route. And when you go non-QM or non-traditional, you're not going to qualify for these programs that actually give you one loan to pay for the rehab cost and the purchase price. You can still get loans, but you're not going to get 100% financing. You need to expect that you're going to put 10 to 20% down if you can't prove your income. So, John, if you are W-2 income and your FICO scores over 660, Freddie Mac Choice renovation all day, all night. It's the best rehab loan I've seen out there, and it doesn't put any limitations. You can use that money to put in a pool in the backyard if you want to.
Now, I like that, because that's actually part of my plan. I grew up in a lot of my life in Southern California, and pools are very relevant there. You fly over from the east, and you fly over into, say, LAX or Orange County Airport. What are you passing most as you're looking down? Pool after pool. I mean, they're living on the ocean. And
it's actually gotten a little bit different. It's gone away from pools and about ADUs. There has been so much push for ADUs.
About what? What's an ADU?
ADU. So it's an additional dwelling unit. You can actually build in your backyard a
Oh,
fourplex.
like a mother-in-law kind of house?
Yeah, that kind of thing. And so what's happening is because you can
Interesting.
rent these for so much money, it's ridiculous.
Oh.
So let me put it to you this way. I had a client that was he was paying $4,700 a month up in Dictionary Hill. And he's like, I can't afford to buy a house. The house that's next to me is selling for $1 million. I'd love to buy that. And I said, you can buy it and pay the same amount of money you're paying for rent. He goes, how? And I said, it's got a permitted ADU built in. Its own 1 bedroom, 1 bath and everything. Those rent for about $2,300 a month. And you actually are allowed to use with these loans, you're allowed to use 75% of the projected rent for any of those additional dwelling units. And so you could literally qualify for the loan. And then with that person's additional $2,300 a month coming in, your payment after receiving rent is about what you're paying for rent. Now you're controlling a $1 million asset that's appreciating at 8%. And so these are the kind of things that's like, okay, well, what kind of loan is that? Well, it's a little bit different. So you're not trying to rehab that one, right? So you don't need to get a remodel type loan. But if you're going into, like if let's say you don't want to remodel anything, most people don't know that you can actually, with no income, now this is going to blow your mind, first-time homeowner, you can buy a fourplex using the projected rents of the other 3 units to qualify and purchase the fourplex and live in 1 unit for free. You can only do this once as a first-time homeowner or after you've not been on title for 3 years, but that program is available for you. It's really interesting how many different programs there are. So ADUs, now when you fly over California, everybody's building duplexes and fourplexes in their backyard and turning into accidental landlords because the land value is so high and the return on the rent is so high that you can actually get the funding needed to build an ADU or an additional dwelling unit, to build it using only the projected rents of what you're going to get when it's completed.
Wow.
Yeah.
That's and I'm assuming, I love it when other shows come on here, adventure show here. I'm assuming that what you just said is the way to go here. What financing option is usually best for someone buying their first investment property? And that sounds like just like what you explained. Either the fourplex, right, or the ADU.
Yeah.
That sounds like, especially for somebody coming in new, because you don't have to build all those other assets. You get, man, these are so many.
So a lot of times what happens is the income might not be enough to buy $1 million home, but if it's got an ADU that's already there, you can buy a property and use the projected rents of that.
Exactly.
Then you move somebody in there and you get to control $1 million asset while somebody else is helping you pay for your mortgage. Now your home is actually creating income. Now I want to blow your mind when you're ready to sell that property and you already have a renter in place. Investors will go hog wild because now they've already got a renter in place in the ADU. Now they just need to find a renter for the main living space. So they're jumping all over that because they have money coming in on day one on an investment property.
Yeah, that's kind of like back in the day when my kids were just little, littler. We went through a couple of periods where we had a much larger house, so we'd rent a room out. That's that on steroids at a whole nother level. I never considered that. I'm glad I brought up the little joke about the pool because that puts it in a whole different perspective.
Well, when some people think of like a house hack, they think about renting out just the room, like an Airbnb kind of thing. But nobody wants somebody in their house that you're living in. Forget about it. But an ADU or a duplex or a triplex or a fourplex, and now you can qualify. You can take your income and the projected income of that one to qualify and purchase a property using just the projected, even if you don't financially, personally qualify for that big of a house. As long as you get that rental offset, they're going to use that money in order to qualify. I mean, Fannie Mae even takes it a step further. They'll use border income. They'll use people that are not on title, like a grandma that's going to be living with you and her Social Security check. So the rules do not necessarily, everybody thinks, well, you know, there's no way I can get into a house. My rent is this. Buying a house is going to be a lot more money. Well, I'm going to show you where to go find a home that already has a permitted ADU so you can qualify and walk into a home. You can live in the smaller one and rent the bigger one out or vice versa. But, you know, it's interesting, like Fallbrook, because of all of the wedding venues and wineries that are out there.
Oh, did you just say Fallbrook?
Yeah. So in
I
Fallbrook,
used to live in Fallbrook. I love that.
so it is Airbnb friendly, meaning that you can go into AirDNA, plug in an address. The website is www.airdna.com. You don't need to pay a membership, but this is what lenders use. You plug in an address. It'll tell you what the projected income of that property will be, and you can use that to qualify to buy it. So I've got one client who actually is ready to buy it's a smaller home. It's on 1.5 acres. So the smaller home is just as you enter in. And then the bigger home with the pool is over here. Well, 70% of the year it's rented. The other 30%, he gets the whole place to himself. He lives in the smaller one. And after receiving money from the Airbnb renters that pay all up front, his monthly payment is like $800 a month for the whole thing. And he's controlling the equity in Fallbrook. Now the home is appreciating in Fallbrook about 6 or 7%. So he's living in the ADU. He's renting out the Airbnb as the host. And he does his own cleaning and his own management and his own website. So I mean, it's all just butter.
Wow, what a great lifestyle.
Yeah.
On top of it. Now I told you normally. Oh, it's another show. Didn't notice that. Anyway, we've kind of talked about this a little bit, and I talked to other guests about this, and while they're here because they want. That's amazing. Almost an hour and a half. Because they're here for the information that they want to learn. But it's still their time. So I like to at least read, even if there's some similarities to what we've already talked about. So the James Show here, and I told you I like the guests to read the comments and for me to read the questions. This is a combination. So I'm going to have you read this whole thing for the green out loud, and then go after the question.
Great discussion so far. What should a first-time buyer focus on most when searching for their first property? Okay, I'm going to tell you guys,
we talked about.
This is really important. Only 10% of the U.S. population stays in the first home that they bought for the rest of their lives. The average person, according to the National Association of Realtors, only stays in their home for 10.5 years. Life happens, people move. Instead of trying to buy your forever home or what appeals to you personally or what you want or what you like, I want you to think of this as an investment, not where you hang your hat. This is a temporary place to hang your hat, but your goal is this is an investment. You can't live in your stock portfolio, but you can live in your primary residence investment property. And that's where I want you to go. So the first thing to do is say, okay, where am I going to go? So in the world of investing, real estate, I will tell you the number one thing is location. You can do an amazing remodel in a crappy location, or you can do a mediocre remodel in a great location, and the mediocre remodel is going to do better. So find a place, that you wouldn't mind living. Like one of my properties is oceanfront. The other one has an unobstructed view of a golf course, and that I could go through all the list of them. Good schools, you're looking for areas that are going to be easy to sell. The first way to do it is look for days on market. Find an area, you find a distressed property, look at the comparables and see how long did it take them after they listed the property to sell it. If it takes 6 months or 8 months or 9 months to sell, even if it got the number that you want, and then another area, it takes only 2 months to sell, think of it as the amount of demand. So think of supply and demand of, okay, a lot of people want to live close to this area. A lot of people like this school district. A lot of people want to buy this. And I'm going to spend less time in there so I can sell it whenever I want to. But what I look for is equity. I look for location. So if I find a distressed property, I find 3 comps comparable, recent sold properties that after they were remodeled, how much you sold. Within about a mile radius, I want to find 3 other properties that sold recently and find that one distressed property. And so I'm going to look at that. And I'm going to say, okay, these other properties, I know how much it's going to cost to rehab, and I know how fast it's going to sell when I'm done remodeling it. So I walk in and I look for those 2 things, location and equity, knowing that this is an investment. You put as much effort into this as you would investing your moonshot on NVIDIA. You know what I mean? Like you spend hours in front of a computer trying to figure out where to invest your stock portfolio. All you have to do is follow the process. And I laid it out in the book. I don't have time to do it right now, but if you follow the process of here's how to find them, you've got a couple of different options. You can A, spend all your time online looking yourself, knowing that there's going to be a lot of competition, or B, my favorite, every weekend for the next month, Find every distressed property in your area, go to the open house, connect with the realtor, let them know that you're looking for a live-in cosmetic flip. You want at least X amount of money in equity after it's remodeled, and you're willing to, you're willing to close fast and all these fun things. And here's your letter of approval, your pre-qualification. Then that agent is now motivated. So I want you to imagine, okay, we're living in $1 million home average area. If I go talk to an agent at an open house, right? They've got tons of time. They're sitting there waiting. And I walk in and say, hey, I don't know if this one's going to work out for me. The margin's kind of tight, but what I'm looking for is this. Okay. I want to get a 3-bedroom, 2-bath, single story, whatever it is that you're looking for that area, for what sells. Now, in my market, the average buyer, and this is nationwide, I think is the same. The average buyer is a Gen X or a baby boomer or a senior. The millennials only make up about 20% of the buyers. Well, what do these age-in-place buyers want? They want single story. They want single living. They want a first floor master. So if you buy a 2-story and all the bedrooms are upstairs, probably going to be harder to sell to that age demographic. So know your buyer, know your location. You go to these open houses and say, this is what I'm looking for. And again, my book lays it all out, but you tell them what you're looking for and do this to a lot of agents. Then when that agent tries to sign you up for an exclusive buyer agent contract, you say, no, I'm happy to do a property specific contract. So any property that you bring to me that works, I'll let you represent me now and I'll let you represent me on the flip. That allows you to not be stuck with one agent. You now have 40 agents looking for homes for you. Trust me when I say your email will blow up and you'll get to cherry pick without having to do all that hard work.
Well, you said it earlier. You said you get 100, whatever the number you said, 100 and some odd emails every day from these different folks, and it's like, it's like leads, right? Business. Like I come from sales, and you can't produce an ending unless you have leads, right? In this case, the leads are houses, and you've got these agents, these real estate folks that are out there working for you for free because they know there's a commission, right? At the end of the day, they're running their own business, and that's bringing leads like crazy. Now, I know we've already talked about this. Ray Drake, he had a question earlier. I think he actually made that comment and then a question that you read. But how do you estimate? And this, I think you answered in that you pull up the Zillow. You say, this is what I want it to look like. This is what it looks like now. Can you give me a ballpark? Okay, I need to look at it a little bit. Then you get to do the walkthrough with the contractor to give you an idea. Is that the best way to answer this?
That's the best way to get. Yeah, that's the best way to get started. Okay, so for example, like if you go and ask a roofer how much it's going to cost to do a roof, well, that depends on if it's a shingle roof or if it's a cement roof. Okay, so you don't get all the answers right up front. What I'm saying is, you take the contractor the first few times, and then you start to build a spreadsheet. What I mean by a spreadsheet is this: there is 3 different types of remodels. There is a refresh, which basically means lipstick on a pig, make it look nice and pretty. But the comps didn't have brand new cabinets; they just painted them. Why would you buy brand new cabinets? You do not want to overspend. You'll never recoup your ROI. So you
overspend beyond the area.
Yeah, right? You don't want to spend too much.
In the area.
Right. So you're just trying to make your subject property look like the other comparable property that you're trying. Okay. So if they use granite countertops, then you need to get a bid for granite countertops. Now, what you're going to find is after doing this a few times, you've got a contractor in your back pocket that wants to work for you. Okay. I can call up Ernie Solis right now from No Limit Remodeling. They got another property. Check it out. Shoot him an email, and within an hour, he'll give me a quote because we've worked together. Now I don't have to, right. Now, the other part of it is this. I've learned in my market that a refresh remodel is about $50 a square foot. A mid-grade remodel is about $75 a square foot. And a high-end luxury remodel is more like about $150 per square foot. So I've already
double that. Okay.
In my market. Okay. Now, how did I figure that out? I built a spreadsheet and I said, okay, here's all of these different, here's the past conversations I've had with contractors. I'm starting to figure out now how much the average he gives me per square foot based on whether it is a refresh, if it's a mid-grade, or if it is a luxury remodel.
Is this in your book?
Yes.
By chance?
Yes, it is.
Ah, okay. Go on, please. Yes.
Yeah.
Wow.
But that really makes it simple for me to go in. Now I know I look at a property and it's 1,574 square feet with a shingle roof. I can do that pretty close, almost to the level of accuracy that my contractor can, because I've done it enough times that I know a mid-grade remodel. Now that could change a little bit, like LVP flooring versus a tile flooring, is a little bit price different. But at the end of the day, you're going to be able to say, okay, here's my 3 different spreadsheet headers, and here's how much it costs for each, for a kitchen remodel that is a mid-grade, this is how much it costs. And I already know that number. So it makes it really simple to do a quick evaluation. And again, this is all information that's in the book, but you can find it pretty easily to build a format for yourself that doesn't take a lot of effort and a lot of work. Or you can do the simple route and just call up your buddy at at your last contractor and say, hey man, here's the address of the subject property I'm going to bid on. And here is the model match down the street that sold for 1.3. Can you tell me how much it's going to cost to make this one, that one? And he'll look at it and say, okay, this cement tile, you can see the mortar starting to fade away. This is either going to be a relay or a replace. A relay is 20,000, a replace is 40,000. He just starts going down the numbers. I want to make my home look like that one. So don't overinvest. Don't spend just because you like, a high-end stove. Don't buy a high-end stove if your goal is to turn around and sell it. You won't recoup your money. You know what I mean? If your comp has KitchenAid appliances, buy KitchenAid appliances.
Yeah, that's interesting. You're saying that because I'm going to get to this question, but I'm going to set it up because you mentioned don't buy the house that when you buy the house, realize that you're not going to be resting your hat in. In other words, average is 10 years. You got to invest. You got to frame what you're looking to do here. And my immediate response, because of what I grew up in, marble tops and granite tops and nice bathrooms and Wolf's gas stove ranges, that name brand kind of stuff. Well, that's not gonna how can someone avoid over renovating and hurting their return on investment? Sounds like somebody was thinking a lot like I was thinking when you how do you do that? I mean, the numbers, what you just talked about, you were leading right in when this question came in.
One of the reasons that I did the book in full color is because I actually wanted people who are reading it to see pictures. There's a lot of pictures in there of exactly what
the properties, right?
Of the property. So I use a subject property and 3 different comp properties, so you can see which one had a refresh remodel, which one are high end, and so on and so forth. But you never want to overspend for the specific type of home. So if the comps you're using,
meaning the area, the comps, meaning the area.
If the 3 other recent homes that were remodeled all had LVP flooring, don't put in solid wood floors. You're crazy. You're never going to get your money back. Just because you think it's nicer doesn't mean that your buyer is going to spend more money for it. There's kind of a cap for every neighborhood. And that's what you want to do, is make sure you're not overspending. You also don't want to underspend. So if your comps have granite countertops and you go to Home Depot and get pressed board, that's just as hard. Yeah, I mean, you do not want to overspend or underspend. And you don't have to think. You don't have to be a designer. You just show your contractor, this is what the house looks like now. This is what I want it to look like. How much? It's so simple.
You're making this too easy, man.
That's the point.
Way too easy. I mean, and it's way too realistic. And I'm obviously being facetious in both those things, but it's very realistic to be able to picture. And I've looked at the book. We kind of put
it's true, yeah. I mean, when you do it once, maybe you're lucky. You do it twice, okay, he's on a roll. But you've done it as many times as I have. Like, this system works. And so, like I said, keeping a promise. I'm not selling anything except for the book. I'm not trying to get a lead in or a sales funnel. I really want to help 500 families get off the sidelines and make decisions. Don't wait around for the interest rates to drop and all this other fun stuff. In fact, in California, the last time that happened, when the rates dropped, people were having bidding wars. They spent $100,000 over asking. And what's crazy is they would have had the exact same monthly payment at the higher interest rate 2 or 3 years before, when they bought the house for $100,000 less. Buy when the interest rates are high, hold it and sell it when the interest rates drop. You wouldn't even have to remodel. In a lot of cases, what happens is when the rates drop, thousands of people come off the sideline. Demand increases. Now, all of a sudden, you got a bidding war. So now being a live-in flip, you have all the power because you can wait out a downturn. You have to live somewhere anyway. You can wait it out until the market shifts in your favor.
And that's like protection upon protection.
Yeah.
You know, like you because you're using the word wait it out.
Yeah.
Because that live-in flip just changes stuff. Look, we've got a couple more questions here.
Okay. Yeah, let's wrap through them. I know we're into this a little time, so go for it.
Yeah, no. So Dixon here says, man, what I mean by that is I'm going to want you to leave the audience here after a bit to what do you want to leave with them as a final thought? And you know what, I would like to do another show. I'd like to keep in contact.
Yeah, let's do it
and do another show here. But when does hard money? We haven't talked about this yet.
Yeah.
When does hard money make sense for a new investor? And I don't know how. He's obviously a little further along than I am. I'm not a dumb guy, but I know I know a little about a lot of different things. That's my wheelhouse. So when he's talking about hard money here, making sense for a new investor, does that match up? Does that question match up? Is that a fair question?
Pretty much. So a hard money, you need to have reserves. In order to even qualify, they want to see 6 months worth of reserves. You have to put 10% down of the purchase price. They'll fund 90% of the purchase.
Back up a little bit. What does hard money mean?
So hard money means that it's not, this is private money. And what I mean by that is
money.
Short term, less than, usually it's 6 to 18 months. Most of them are 12 months lengths. That means you're going to borrow X amount of money and you have to pay it back within that 12-month period. At the end of that 12-month period, if you don't pay it off, they can take your house. Now, this is usually done in the name of an LLC. It's not primary residence at all. You need to open an LLC. You need 6 months worth of reserves. And what I mean reserves is all of the costs, the holding costs, principal, interest, tax, insurance, associate, everything.
Wow.
You need 6 months to even qualify, plus 10% down to the purchase price. And then on top of all of that, you need float money. Float money means that in their world, you have to front the money for a renovation. You can get up to 11 draws. I'll use Kiavi, one of my favorite hard money lenders, Kiavi. You can go directly to them and pay the same points as if you came to me. But if you want to check it out, the average interest rate is around 10.45%. You're also 10.45%. That's hard money. Don't confuse this with DSCR. We'll get into that, but you're also going to pay 1 or 2 points, and that is 1% or 2% of the entire loan amount that you're borrowing up front, because unlike a long-term traditional lender, they only make their money in a very, very, very short window, right? And they're taking
Why would you do that? Why would you use hard money? What's the advantage?
The only reason you would do that.
So harder than everything else.
That is what the real estate investing coaching programs are trying to do, is scare you into it's really hard. You need help. You need partners. And you do if you're using hard money. After you've earned enough money, okay, after you have enough money in your bank account to do a hard money loan, you'll want to have big reserves, a lot of down payment money. Why would you do it? If you're in a home like I am right now, I'm in a condo. My wife and I love being at the beach. We didn't want to move into the next one. We didn't want to sell this one. This one's appreciating so fast. It would be crazy. It's now worth 1.525. I bought it for 1.25 about a year and a half ago. But I don't want to leave it, right? I'm going to hold on to this property. The property that I purchased, I found the deal because one of my networked agents said, hey, man, I found this property. Check this out. It was something that would qualify for a hard money loan. Now, I have plenty of reserves to be able to front the money. So I put $100,000 into it from the HELOC, right? The home equity line of credit. I put $100,000 into it. And then I had it remodeled and it was vacant. Okay. I'm going to tell you, this is scary at this point. I'm going to just be blunt.
Yeah.
I wanted to sell it. It didn't move. I'm holding it for 6 months. Each month that goes by, it's $10,000 is my holding cost. $10,000 a month. So $60,000 out the window. Now, I would never encourage a brand new investor to do this, because if you have to transition from a hard money loan to put a renter in there, like I had to, then you have to qualify for what's called a DSCR loan, or a debt service coverage ratio.
And I want to talk about, you said we're going to get into that.
Yeah.
Now is a good time. Talk to me about this.
So debt service coverage ratio is just a very creative way. The simplest explanation is it's a measurement of whether or not the property cash flows positively or negatively. In other words, if you can only rent the place for $5,000 a month, that means the maximum payments you have with principal, interest, tax, insurance, association can only be $5,000 a month. It has to be a 1.0 or higher. Now they do have some that are lower called they don't cash flow very well, but you have to have even more reserves in order to have that, to make sure that they can use your assets and say, well, the rent's not enough to pay this monthly payment. Even with the renter in there, you're going to have to come up with a subsidy of maybe $2,000 a month. Does this person who's getting that loan, do they have enough assets? And so sometimes you have enough equity in the property. Most people don't know this, but if you're a real estate agent and you lower the price, then when you go to try to refinance it to a DSCR, they'll only use not the appraised value, but the price that you couldn't sell it at. So as low as you dropped it, they'll only go up to about 70 to 80% of that loan to value. So now you got to bring even more money back to closing. So hard money is very, very risky, and I would encourage only people who have done this many, many times to have a lot of confidence and have a way out. Now, as a real estate agent, I have an edge because if I'm selling a property, I don't have to pay agent fees. So you got $10,000 a month going out in holding costs. Now you got to pay, if you paid 5 points on $1 million home in California, that's $50,000 you're going to lose just to real estate agents. So the list just goes on and on and on and on. So 6-7 months go by and you can't rent a place out. I've helped a lot of different, people that were accidental landlords, flippers that couldn't unload a property in time. They're all scrambling to get a DSCR loan, and some of them didn't qualify. They didn't have enough reserves for the DSCR. They didn't have enough down payment. So they lost the house. The hard money lender took it. Now you're an LLC, so there's no foreclosure process. There is no eviction process. It's a business, so they don't foreclose. They just take the house. They now own that house. So with that in mind, I would never encourage anyone to do hard money unless you are so confident you can A, you unload it quickly, or B, as a backup plan, you better have enough money to be able to refinance this into a DSCR loan and put a renter in place. And renters are never 100%. They can lose their jobs. They can get divorced. They can go through whatever they're going to go through. Plus, they might do damage to the house. That just
it could be a real pain in the ass sometimes.
You never know. So this is why living in your flip it just makes so much sense. You just don't have to deal as a landlord. You don't have to pay property management fees. You don't have holding costs because your rent is your holding costs. You're literally exchanging what you're currently paying for rent to live in your flip. So even if the market changes, even if things go sideways, what the worst that can happen is, let's say your air conditioning goes out and you've got to pay for an air conditioning. Well, when you get a new appraisal on your property, you might have a first mortgage, but just like this condo that I'm in right now, the forced equity after I did the remodel, all of a sudden it's worth more money. I need an AC, no problem. I just go to the bank, get a home equity line of credit, buy a new AC. You get so much leverage when you live in your flip versus a vacant flip. And that's why if you're able to and willing to move around, you can literally make enough money that you can retire in a matter of 5 to 10 years as opposed to punching a clock. And that's exactly what my wife and I did.
That is huge. That is such a realistic approach.
Yeah.
Whether you want to be, as I said in the beginning, a real estate mogul, and have, like you, have multiple properties, but that protection of living in your flip. If there's a turn, if there's that, all you're doing is doing what you would do if you didn't own the place. If you were still renting. Like you said, you can use the leverage to actually pay for whatever it is that you may need. Now, it looks like everybody's kind of winding down here. We still got a lot of people on, but the questions are kind of winding down here a little bit. So I'm going to ask you, as I mentioned before, Rich Inson. I'm going to ask you to read this out loud, and then I like this question, how we're ending this on talking about back to the realtor thing, because I think this is an important question. There's shortcuts, and then there's cutting corners, and those are two different things. bad and good, right? So I want you to read this and then out loud and then respond to it, and then go into what you want to leave everybody here as a final. What do you want to leave your thousand? Oh my God, your thousand. No, I shouldn't say that. It's a topic that people need.
Yes, yes.
And because
really
homeownership is, they say that this generation, my kids' generation, probably your kids' too.
Yeah.
I don't know how old you are, but my kids are right in that 48-year-old age range. But that generation is going to be the first generation since the Great Depression that haven't lived, that have a lesser lifestyle than their parents, meaning it's really hard to buy homes now. That's the thing going on, especially California, because of the stuff, because of the cost of living there. But it's not.
It's not. With a house hack or a live-in flip, you can change the game. Yeah. And so, Richens, what I would read is really enjoying the live conversation. How important is having a strong local realtor when searching for investment properties? So I will tell you that I actually dedicated my book to my first real estate agent. His name is Dion Stahlberg, and he's in Mission Viejo. And he was instrumental in finding that for sale by owner. You'll find that if you go to these open houses of distressed properties and you connect with each one of these real estate agents and tell them what you're looking for, and they know they get to represent you to buy a property that's distressed, they can usually attack a for sale by owner person who also doesn't have representation and cut a deal where they can walk into a lot of money to represent you. So they'll start hunting for deals for you. And so the idea is not to have one strong local realtor. It's to have like 40 of them. Every open house go in. Yes, they're working for free for you because the seller is going to pay them to hunt for homes for you to buy. And so there will come a point in your career where you decide to become your own real estate agent because you start to see how good, how good it is to actually keep that piece of the pie that you were giving away. But what I would suggest is in the beginning, go to as many open houses as you can for distressed properties. These people that are hunting for homes, are typically trying to find off market. They're working through wholesalers. You're going to go talk to realtors who have their finger on the pulse of distressed properties. Tell them what you're looking for, and you're willing to let them represent you to buy the property and to sell it when it's done being rehabbed. And you get as many of those guys as possible in different areas. So, I mean, when I was looking, you go to realtors in Huntington Beach all the way down to San Diego. I had all of these different markets looking for a realtor. Looking for a flip. All of these different realtors that are hunting because that's their job. That's how they make money. And again, I would say that the most important thing is, where do you find these guys? There are meetup groups, there's Facebook groups, there are tons of different groups.
Good ideas.
For that people gather around, and real estate agents are desperate right now. They will work their tail off for you right now. So just to kind of give you an idea, there are 40,000, Richens right now in San Diego, there are 40,000 licensed active real estate agents. There's only 6,000 homes on the market. That means that there's
40,000 agents.
40,000 agents
in San Diego.
And there are only 6,000 homes on the market. That means for every home that's listed, there are 4 agents competing. If you show up with a pre-qualification letter and tell them, hey, I'm a new flipper in the area, I'm looking for a primary residence, live-in flip with a Freddie Mac choice renovation loan, I'm looking for this type of property, whatever, they will go hunt and find you one. They'll represent you, knowing that they get to represent you when it's time to sell it, because you don't have an agent to sell. Of course, you're going to use them. So they see you in California as a dual on buying it and a dual on selling it, and that's $100,000 to a desperate agent. Trust me when I say they are out there, they are hungry. You're not going to go to the top 10% producing agents to do this. You're going to go to the hungry ones they're ready to roll up their sleeves and start making phone calls to old expired listings into for sale by owners.
Wow. Yeah. I love the way, I told you before, I love doing the show because it's one, getting access to the information we wouldn't normally see, but also this is potentially, well, it is, but the results are bigger or smaller depending on how many people know. But this is changing an industry. This is totally changing an industry in a way that improves the industry and just opens up to that many more. You said yourself, your sister said, I can't qualify for this.
Yeah.
And she could, and she did actually, right? And so at the end of the day, this is the kind of conversation I really like, because it's changing an industry.
I was going to say that it's not only changing an industry. I am not everyone's favorite person right now, Rodd. I'm not in the industry. They hate me because if I teach enough people how to find, fund, and flip properties using primary residence rehab loans stacked with a down payment assistance program and seller concessions, then all of the wholesalers are out of business. All of these realtors that just want to go in and sell a distressed property, are excited about it, but everybody else hates me. The real estate investing coaching model, they want you to believe it's so hard, but they're fleecing people to the tune of $10,000 to $30,000 for programs that don't work. If they truly were doing that well in the industry, then why in the world do they want your $20,000 or $30,000? They're making their money off of screwing you, not helping you. When I teach enough people how to do this, wholesalers are pissed off at me. The real estate investment coaching programs are all pissed off. Everybody's upset that I'm teaching this to regular, everyday people for programs that are already out there that nobody seems to know about.
Yeah, and that's what makes the world go round, and that's what makes America, or the world, a beautiful place to be. Why don't you give everybody a big wave? I'll throw you in the green room. Leave the peanuts alone.
Awesome.
Okay? And I'll catch you on the flip side. I'll wrap it up.
All right, sounds good.
All right, Bryan. That oh my God, that was exactly the kind of conversation that I wanted to have, because I came into it generally curious about the live and flip. I love that concept. I love that program. And as everybody now knows, not just because I thought it would make an interesting episode, there's something here. And again, no matter where you are in the country, the numbers or percentages, or let's call it margins, change depending. But look at this. This can easily be done. So I'm looking at this personally, and what I appreciate is that we've been able to get underneath the headline. We built wealth without that big money. Sounds great, man. But the important part is understanding what actually has happened between hearing that idea and then successfully executing it, right? You've got to understand the property, right? You've got to understand different financing options that are available to you. Look up his book. Oh, wait a minute. Hold on, folks. I messed up terribly here. I am going to stop hanging out with you for a second. And as I always promise you guys, I am going to put these comments in. Control V, not the comments, the information on Bryan's contact information. Just get this one in. Bryan, I don't think you gave, there's your phone number, but I don't think you gave me your, the Amazon link. And let me bring you back on, because I did not finish one thing here. Sorry, I know we're usually a little bit more professional than this. But Bryan, did I get your? I always kind of cheek and tongue at the end of each episode before I do the monologue. Usually I say, "All right, I'm very proud of my copy and paste skill set, and because I work really hard on being able to copy and paste." So this one here, that is your email, obviously, right?
Yep.
This here is your phone number, and that's your website, I'm assuming.
Yeah, the website is bryantherealestateguy.com, and on the bottom of every page on that website is the link to, on the first page and on the author page are links to where you can get the book. But also my YouTube channels and everything else. I want to help you win. It's all on that website.
All right, brother. Give everybody another wave. Bye-bye.
Thank you.
So you've got to understand all these different things, right? You've got to understand renovation costs, a couple things that help you not go flying down in flames, right? Those renovation costs you got to understand. You've got to understand your own financial position because there's different buckets for you to take a look at depending on how that sits. You've got to understand the market, of course, but all these things along the way are fascinating, especially the live-in flip, because if the market changes, as we were just talking about, you're writing it out in your own place. And you've got to understand the risk, That's the part of the conversations about wealth that just sometimes they get lost. There's no magic button here, folks. There may be strategies available to everyday people that simply haven't been taught, that they haven't been taught to recognize. That's why today's episode blew my mind, because we haven't been taught to recognize these things. And that's what interests me about what you're doing. Bryan, what you're doing is fascinating. The idea that somebody who's already paying rent every day, every month, might be able to begin thinking differently about that same housing expense and potentially use home ownership, a live and flip, house hacking, love that, or another real estate strategy as the first rung on the wealth building ladder. That deserves serious examination. And especially like your goal of, I really love helping 500 families do it. I'm one of those. I'm gonna work on this. It's too much not to, folks, because that's where this conversation connects directly to what we talk about here every week, every day, really, empowering the great middle class, one conversation at a time. Not everybody is trying to become a real estate mogul, right? I'm not. Well, maybe after a while I might want to. Most people aren't looking for 100 properties, right? That they're trying to create some breathing room, I like to call it. They're trying to build equity. They're trying to stop feeling like every dollar they earn immediately disappears. You know that feeling? They're trying to build something they can eventually leave their kids. And sometimes building wealth, well, it begins simply learning to look differently at the money that you're already spending. Bryan, you've definitely given me some things to think about here, to get your book. And I'm probably going to have some questions for you after the cameras turn off, right? Because I'm serious when I say I want to determine whether there's a practical way for me to put some version of this strategy to work personally. For everybody watching, I want you to remember something important. Don't leave this conversation thinking Bryan told you to run out tomorrow and buy a house. Educate yourself. Get his book. Understand the numbers. Understand the financing. Do your due diligence. Ask questions. Talk to qualified professionals, of course, and never put money into real estate transactions simply because somebody on the internet said, make it sound so easy. The whole point of today's conversation is exactly the opposite of that. Learn enough to make an informed decision. Bryan Anderson, the real estate guy, thank you. Thank you very much. Thank you for coming to the table. And thank you for being willing to let me push into the details. And to everybody who joined us today, you blow me away every show, guys. You blow me away. Thank you for being part of this community and these kind of conversations. These conversations as a whole. If something we talked about today helped you think differently about home ownership, investing, or building your own financial future, you know what? Share this conversation with somebody who needs to hear it. And if you'd like to help us keep these conversations like this going, you can support us on Insights and Straight Talk through our Ko-fi page, ko-fi, Kofi.com/Rodd Duff hosts of Insights. So RODDDUFFHOSTS of Insights and Straight Talk. And we're still, oh, by the way, the link's in the description. If you want to buy us a cup of coffee, please do. It helps. It really does. And we're still building our new Facebook community. We stream out to private chats here. It only gives us a couple hundred people that we can get on Facebook. We also do StreamYard and YouTube and LinkedIn at the same time. But that with 100 more followers, we need to reach 100. We're at 80. I think we started the page here a couple of weeks ago. We're at 82, I think. I'm not sure exactly, but like there. And we need to reach 100. That way we can stream these conversations publicly instead of privately. Follow the page, and that's on the link as well, on the description. But then bring one person with you. See where I'm going with that? I'd read out the link, but it's easier just to hit it in the description. Every follow matters. Every share matters. Every person you bring into this community helps us expand the table. It's that simple. I'm Rodd Duff, and this is Insights, the Straight Talk, empowering the great middle class, one conversation at a time. We'll see you at the next conversation. And with that, I am out.
Before you leave, if you'd like to watch another one of the podcasts, click the first link in the description. We love having you here and we appreciate all your support.
And with that, producer Barbie and I are out.